For months, global markets have been pricing in the threat of a full-scale conflict in the Middle East. But late Tuesday night, the U.S. suddenly paused its naval escorts in the Persian Gulf, signaling that tensions with Iran are cooling down. This chart tracks the price of Brent crude oil over the last few days. You can see the impact as oil prices plummeted from $115 down to around $108 a barrel. Cheaper oil removes a significant tax on global growth. It reduces the immediate threat of high inflation mixed with zero growth and gives the Federal Reserve room to keep interest rates steady without inducing panic. Wall Street celebrated instantly. By Wednesday morning, this geopolitical relief rally pushed both the S&P 500 and the Nasdaq composite straight to all-time record highs. While the surface looks like a universal victory for the economy, these record-breaking numbers are masking a divergence in who is actually doing the buying. Institutional giants are using this peace dividend to aggressively buy into technology stocks, yet everyday retail investors are doing the opposite, quietly moving their money out of the market. The entire market is currently being propped up by one highly concentrated group, setting the stage for a high-stakes collision where one side has to be completely wrong. Big tech is locked in an arms race to spend over $1 trillion by 2027. This capital is flowing directly into physical internet infrastructure, the actual hardware required to run artificial intelligence. We can see this spending spree in the recent earnings from Advanced Micro Devices. AMD's first quarter results for 2026 showed a performance that completely exceeded market expectations. AMD's data center revenue jumped 57% to $5.8 billion as cloud providers deploy their new Venice processors. To link these chips, companies turn to Arista Networks for the high-speed Ethernet required to connect these massive hardware clusters. Institutional asset managers are buying into the hardware providers, supplying the tools for this trillion-dollar expansion, because the physical deployment of AI is accelerating. The Schwab Trading Activity Index, or STAX, tracks exactly what individual account holders are doing with their money. In April, it ticked down to 50.10, sliding directly into conservative territory. Individual investors are actively selling off the same high-growth tech stocks that institutional giants are buying. The average person is much more sensitive to the local economy than a multinational hedge fund. They are heavily exposed to high borrowing costs and remain worried about persistent prices in the service sector. Instead of chasing semiconductor rallies, retail money is rotating into broad-based exchange-traded funds and lower-risk defensive assets. Wall Street is doubling down on a concentrated tech boom, while Main Street is de-risking in anticipation of a broader economic crack. The sheer volume of institutional capital will likely push AMD's stock price to break past its previous all-time high of $362.79 before the week is out. This AI momentum is currently large enough to suggest that the S&P 500 will continue its upward climb in the immediate future. But this entire record-breaking market structure is resting on the outcome of the ongoing diplomatic peace talks happening in Pakistan. If those negotiations break down, the 20 million barrels of oil moving through the Strait of Hormuz are immediately at risk again. Brent crude would snap back above $130 a barrel within 48 hours. An oil spike of that magnitude brings inflation back into focus, which could trigger a rapid overnight 3% wipeout across the S&P 500. Will you buy into Wall Street's trillion-dollar hardware race, or are you preparing for a market meltdown alongside retail investors? Let us know in the comments below.
An investment in knowledge pays the best interest, so why not invest in this channel? Click like and subscribe for more.